The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
This is the Ascent, brought to you by Crestmont Private Wealth. My name is Sam McGee. I'm the CEO and owner. We have offices in Houston at One Riverway, pretty close to the Galleria, and 604 South Main Street in Boerne, which is the historic Main Street in Boerne, Texas, just outside of San Antonio. Today, we're going to be talking a little bit about asset class performance over the last 10 years. This is a really interesting topic because 10 years, A, is a long time. B, most people tend to get caught up in what we call recency bias. And we talk a lot about recency bias on this show, behavioral finance, a lot of different biases. But recency bias is one of those things that can really get us in trouble as investors, because it points to the most recent euphoric or painful thing and tends to impact our decision-making, either fear of missing out or regret. From a portfolio management standpoint, from a wealth management standpoint, we really want to focus on individual small decisions in how you allocate your portfolio, doing it in a responsible way as a fiduciary, depending on your age, your time horizon, your risk tolerance, your tax situation, your ability to take risk, your willingness to take risk, and your temperament in what you do when markets go way up and go way down. So why is this so important? Because this time of year, in a good year, there tends to be, if you weren't invested, a tendency for a lot of folks to have that missing out kind of feeling. And those that may have been burned before in the past in terms of their investments, and we've had a pretty good year in the markets this year, tend to think, oh, well, I need to do something because that means that the shoe's going to drop. I want to give some statistics here to really take a wide-angle lens and zoom out to help our listeners make sense of why asset allocation makes sense. So we're looking at a quilt chart right in front of me. It's basically imagine one of those blankets that has 100 T-shirts on it, right? You've probably seen these things. There's 100 T-shirts on this thing. They're all different colors, and it's called a quilt chart. That is what I'm looking at, but it's asset class performance from 2013 through 2023 and then year to date. Each year, you have different groupings of asset classes. Now, what is an asset class? So let's use 2013 as an example. Small cap is an asset class, small capitalization stocks. So that is small-ish companies, not massive mega companies like AT&T or Google or Apple. We're talking about smaller companies. In that year, 2013, small capitalization stocks were the highest performing asset class. 38%. Now, that's not net of fee. We're talking about just indexes. And then the next highest performer in 2013 was 35%. And if I go down the list, you have growth, then you have value, then you have large capitalization companies, then developed markets. That would be your non-US, such as Europe and Japan and more developed countries. That one is right in the middle of the road in 2013 at 22%. And then you have real estate investment trusts below that, then commodities, which would be your oil and gas, mining securities, and then bonds, and then emerging markets at the very bottom. If I've lost you, you're probably not alone. This is a lot to take in. What we are talking about is asset class performance over the last 10 years and why it matters. So I'm framing this up. So over 2013 to 2023, I'm going to tell you what the top performers were first, going left to right. Small capitalization in 2013 was the top performer that year at 38%. 2014 was real estate investment trusts at 30%. In 2015, it was growth at 5%. That is an asset class. Imagine growth companies. In 2016, it was value companies. Think about more mature companies. In 2017, it was emerging markets at 31%. In 2018, the top performer was at 0%, and that was bonds. Pretty tough year. Okay, that was the top performer in 2018. 2019, 31% at value. 2020, 33% at growth. 2021, 40% real estate investment trusts. 2022, 24% was commodities. Now, 2022 was an interesting year because that was the top performing asset class. Everything underneath that on this quilt chart, which you can get from us, and I'll explain how you can do that in a minute, everything beneath commodities in 2022 was negative. Bonds, all other securities, negative. Really tough year, really interesting year. Stocks and bonds in general were down, but commodities were up. Now, commodities would be oil and gas, mining, futures on agriculture, et cetera, et cetera. 2023, the top performer was large capitalization companies. And year to date is growth at 38%. So why do I give you all these stats? The reason I'm giving you all these stats is because there's not a pattern to it. There is not a pattern. If you want to see this chart, I'm going to take a snapshot of that right now, and you can reach out to us at info@crestmontpw.com. It'll have a timestamp on it, and you can look at this visually and see there really isn't a pattern between the top and lowest performers across all these different asset classes. And what we're looking at is large cap stocks, mid cap stocks, small cap stocks, growth, value, emerging markets, developed markets, aggregate bonds, TIPS, real estate investment trust, and then commodities. So as an investor, the reason this matters is back to what I brought up at the very beginning, recency bias. Recency bias is really, in a nutshell, the concept of the most recent thing that I've seen tends to get overweighted in our minds. So let's use an example of that, all right? So let's say we are in Texas back in early spring or technically winter of 2021. Does everybody remember that big ice storm that impacted the entire power grid across the state of Texas? I certainly remember it because my pool equipment froze. Now, during 2021, during that ice storm, that was a huge deal because it impacted the entire state. And as we came out of that, there were all sorts of reports about ERCOT and all this concern about everything that was happening, and probably rightfully so, but all this concern that was happening with the power grid and with local utilities and how they were handling water and et cetera, et cetera, et cetera. Have you really talked about that or thought about that in the last 2 or 3 months? Probably not. But back then, if you take yourself back in time, the recency bias would be you probably were thinking about, how do I insulate my pipes? How do I make sure I have a generator? What can I do to prevent this from happening? And then all of a sudden it kind of fades into the background. That is a great real world example of recency bias. The problem's still there, right? We could still have a really deep freeze. It could still happen, right? But we're just not thinking about it. Our brains are wired to think about the most recent thing. So how do you combat that? You combat that by looking at historical trends. You look at what's happened over a long period of time. So you can have awareness of the what if, what may happen. So if I were using this analogy of weather, I would look at the last 10 years and how many times where I live, it got below freezing. That's what I would care about. Is this every 5 years? Is this every 2 years? Is this every year? Is this every 10 years? Well, usually, not always, past performance does not equal future performance. But with trends, they can happen again. They can repeat themselves. So by taking a look at the weather data over the last 10 years, you can go, you know what? This area, I'm going to freeze, so I probably ought to insulate my above ground pipes. Same concept with asset allocation and portfolio management as it relates to being a fiduciary and managing your portfolio, or the professional that you hire to manage it for you. They should be looking at historical trends, current market environment, taking a look at what could be shifting out into the future, and looking at how to allocate your portfolio so you don't have all your eggs in one basket. We just talked about the asset class performance over the last 10 years, and I pointed out the top performers of this chart, which you can obtain from us. The source of this is FactSet Research Systems. That's one of the providers we use. Now I'm going to talk about the bottom performers from 2013 all the way until year-to-date as of this recording on 12/9/2024. And so in 2013, going across all the way to 2023, left to right, the bottom performer starting in 2013 was tips, then commodities again, then developed markets, then tips, then emerging markets, then tips, then commodities, then aggregate bonds, then growth, then commodities, and year-to-date aggregate bonds. So why is this important? There's not a trend. So having a broadly diversified portfolio that is matched up to your risk tolerance, your time horizon, your tax situation, your income, your expenses, your overall portfolio, and considering the assets that are out of your portfolio, all those things add up to what is the proper asset allocation for you to have to be broadly diversified enough that your figurative pipes don't freeze. Don't put all your eggs in one basket. Be broadly diversified enough that you can weather those storms in the market, that you have a portfolio that you can live with, through the ups and downs and within the bounds of fear and greed. Again, recency bias can be a very troubling thing because we are addicted to these little handheld devices on our phone. You see constant information. The best way to combat recency bias is to take a longer-term view and educate yourself on what has happened, what can happen, and consider the merits of a broadly diversified portfolio that's right for you. Now, at Crestmont Private Wealth, that's a very individual, customized, idiosyncratic decision, very much relating to your own individual situation. And that's something we do. We take you through a full risk tolerance. We understand your complete and total financial picture, and we're here to serve you as a fiduciary. If this has been interesting to you and you want to get our weekly newsletter, you can do so by emailing us and making a request, newsletter in the subject line, and send it to info@crestmontpw.com. We'd be happy to send you a copy of the recording of this radio show, which is broadcast on most major podcasts, along with this graphic that I described on the U.S. multi-asset class performance comparison over the last 10 years. I found it really interesting. I think it's really neat to be able to see that there's not really a strong trend for any of these particular asset classes. There's a tendency, but in general, it really helps me as a professional to look back and go, yeah, it's kind of all over the board. Diversification makes sense. I hope this show has been interesting to you, and we're coming up on Christmas season, and I hope that all you families out there spend great time with your loved ones, stay safe, and God bless.